All right, what is up, traders? What's up, tycoons? Super excited for today's video. Coming at you guys with another Tycoon talk. This is going to be episode 10. And in these episodes, in this video series, we basically go over stocks, bonds, and crypto, as well as other economic and financial data. So we're going to go over a few different things today. Make sure to smash that like button, subscribe to the channel if you guys are new so you don't miss any of the future videos. And the first thing that we want to go over before we get into that, we're going to go ahead and read this quick disclaimer. Okay, so the content provided in this YouTube channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. Myself and any individuals that appear on this YouTube channel are not registered financial advisors or brokers. Trading in stocks, bonds, commodities, and crypto involve a significant risk of loss and is not suitable for all investors. So be sure to read through the full disclaimer, but we're going to go ahead and jump right into it now.
Right.
And so the first thing that we want to talk over that me and Leon have been talking about is the core sticky inflation and the Fed fund rate. So what we have here in yellow is the core sticky inflation, and then we have the Fed funds rate here in white. Now on Friday in particular, the market had a pretty big crash around 10 or 11 a.m.
Flash
And
crash.
it was
Six
a
minutes.
flash crash.
Yeah.
And I don't remember what bank it was, but there was basically some report that came out that basically they were saying that inflation is a lot stickier and that they see it remaining higher. And I've kind of been highlighting this a lot, specifically with this chart right here, in a lot of my videos. And the main thing that I want to show is that really core sticky inflation doesn't really tend to see a big move to the downside until the
hmm
Fed funds rate is above it, right? And so we can see that here when the Fed funds rate get above core sticky inflation, then you see the core sticky inflation actually start to drop pretty hard. And the same thing happens over here as well. And this is something that's happened many times in the past. And core sticky inflation, Leon was pointing out, it's at levels that we haven't seen in very, very, very long times. So, many people are pricing in rate cuts and, keep speaking of rate cuts. But me personally, I don't necessarily see that coming too soon. Now, does that mean we can't get a pause? I mean, yeah, we sure probably will be getting a pause sometime soon in 2023, but that doesn't necessarily mean that they're going to do a whole U-turn and actually start cutting rates aggressively. As you can see, the core sticky inflation, it peaked, but it hasn't really started a downtrend. It's really just consolidated sideways, since the beginning of the year. Now, one of the reasons that I think that inflation is going to stay up and stay sticky is because of crude oil futures. Now, OPEC recently announced that they're going to be cutting about 1 million barrels a day, and that's going to go on, I believe, from May to September. So we haven't even actually started seeing those oil production cuts come out yet. But what we have here is the crude oil futures in yellow, and then we have core CPI, which is core is what the Fed mainly pays attention to.
hmm
Right. And we can see that crude oil futures have actually broken a little bit of a downtrend, right? Whether you want to start the downtrend from here, we just broke through that trend line, or, more recently, we just broke through that downtrend. And it's not going to be reflected yet in core CPI for a little while because core CPI, the CPI itself is very lagging. Okay. It's always on the data from the month before. And, in this case right here, we can see that in March, right, crude oil futures peaked, but the actual core CPI did not actually end up peaking until about April, May. And then it went flat. And then we saw another increase in the crude oil futures. And what do you know? Core CPI came up. And the reason that this is affecting things like core CPI, which excludes food and energy, is because energy prices are going to spill over into pretty much all forms of inflation, right? If energy costs more, then generally, all of the goods are going to cost more as well due
hmm
to the simple transportation costs. Um, so just because the Fed is keeping rates higher does not mean that the stock market cannot go up, right? And so one of the best things that me and Leon have found really to show this is the Fed balance sheet, which is going to be here in orange versus the stock market. So the Fed can, in a sense, do both things at the same time. And when I say that, what I mean is they can keep rates high and keep kind of raising rates or keep them elevated without cutting. But they also can print money, right? And historically, anytime that the Fed is printing money, the stock market is in a bullish cycle.
On up.
And it's going up, and that's what happens. And so the stock market peaked right here in the beginning of 2022. And we can see that the Fed balance sheet also peaked right after that, and it's been going down, and the stock market has been going down as well. And it's really just, kind of shows throughout the
Same
history
thing
of the
happened in
chart.
2009.
This is
Mhm.
2009 right over here, for the viewers watching. And if we zoom in a little bit more, we can see here that since the banking crisis, a lot of people have been baffled, and like, they're wondering, why is the stock market rallying when we have this banking crisis going on? And look at the time horizon, right? So what happened is the Fed kind of bailed out a lot of these banks, and they bought their treasuries. And so what they did was they added to their balance sheet by
Mhm.
purchasing these toxic assets that the banks were owning. They added to their balance sheet, and we see that we had a huge spike in the balance sheet. And what do you see? A huge spike in the stock market. We have the SPX here in yellow, and we have the Fed balance sheet here in orange. And so, currently they're still doing quantitative tightening, and that's why we've seen things kind of pull back a little bit. But if they stop quantitative tightening, okay, we could actually go back into another bullish cycle in the market, just
And real
simply
quick,
from the fact that the Fed is, adding to their balance sheet.
you can actually see it kind of turning up a little bit at the end of that trend line right there. It's actually turning up. Also, if you want to know how you actually, find out if the Fed is adding to the balance sheet, every Thursday they release it. It's updated, I think Wednesday or Thursday, on the Federal Reserve website. They release it. They release segments, so you don't have to download the whole thing. If you want to, you can. They can separate it by assets. Like they have like 4 different tables, and it's really descriptive. So if you want to just take that time out to look at that information yourself and see when they're adding money to the balance sheet to kind of stay ahead of the curve, that's how you can do it. So
And so we're kind of just showing this because a lot of people are very bearish, right? And they're looking for all of these really big bear case scenarios, but it's almost as simple as, is the Fed balance sheet going up, then the stock market is going to be going up, right? That's kind of what this data is showing you guys. And that's where the whole saying of "don't fight the Fed" comes from, right? If the Fed is adding to their balance sheet and stimulating the economy, and you're trying to fight the Fed and say that a massive crash is going to be coming, then that's going to be a losing battle historically, just based on the
mhm.
pure data itself. Okay, now not only does the Fed balance sheet give us a possible bullish scenario here, because a lot of people are focused on inflation and saying that, hey, the inflation is going to be too much, and that's what's really going to cause the market to have the next leg down, is because of the Fed fund rate and inflation. But if the Fed starts upping their balance sheet again, and the debt ceiling is going to be the whole debt ceiling debate is really going to be finished in the summer, is when they should, come up with if they're going to raise the debt ceiling or not. And if they raise that debt ceiling again and start adding to the balance sheet, most likely that's going to incur with a bullish stock market cycle. Now, besides that, we also have financial conditions, right? And so one thing that we noticed when we were looking, all right, we have the adjusted national financial conditions index here in white, and then we have the regular national financial conditions index here in this kind of blue color. We have the stock market in yellow, as well as the Fed balance sheet in orange. And when you see these crossovers is typically when you start to see the market go a little bit bullish. The
Major
crossovers
key.
between the national financial conditions and the adjusted national financial conditions index, right? And so if we go to some other slides over here, it becomes a little bit clearer for you guys. And so you can see here, once the adjusted national financial conditions index crossed down below the national financial conditions index, right? We started a bull cycle here that really remained as long as this was down below, right? The stock
It's
market
a little
continued to
early.
go up.
It's a little early.
Hmm.
Like it starts a little early before it crosses. So like if you want to catch it, like yeah, it's
Yeah. And this is just kind of showing you guys the same thing. We get that crossover here, and then the market bottoms shortly afterwards, and we see the stock market continue to go on a really, really big move to the upside. So that's something that we've just kind of been looking at. Really just trying to figure out, hey, why is the market really rallying right now? If you notice, there's really low volume. If you take a look at this S&P 500 chart real quick, the volume's been in a downtrend, but meanwhile, the stock market's been going up. We've been seeing all these reports about hedge funds are overweight cash and underweight stocks, but meanwhile, stocks are still going up at a rapid pace, and really just, doing very well in Q1. And I think that the Fed printing money again and or rather just adding to their balance sheet is something that was really fueling that and driving it. So these are Leon's charts right here. I'm going to go ahead and let him explain what it is that he's looking at and what it is that he's got right here for us.
And just real quick, it's adding to the Federal Reserve, balance sheet that he showed and the national financial conditions. So just looking at the candlesticks, we know that the price action and technical analysis actually shows us what we need to see before we have the catalyst, and we have what actually shows us why it's doing that. So everybody's like, okay, the market's going to drop, the market's going to drop. We were saying the exact same thing, but we always actually figure out why we're wrong. So earlier, I think it was midweek last week, we kind of made a pivot, and we were like, okay, you know what? This is what's going to happen. So, we were able to make up for the positions we were in and make some money. But what we're looking at on the left-hand side is in the yellow, you'll see areas of liquidity at the two top ones, and at the bottom you'll see an area of liquidity in the like bluish purple. So we actually passed every single swing high in the middle. So in the middle you'll see the swing highs. We passed all of those. We're past the breakout point last week. So if you can kind of chime in on that, yeah, that past swing high in the middle. So right there in the middle, yeah,
Over here.
those we're above all of those right now.
Mm-hmm,
Like we closed above them.
and that was a close. That's a
last
weekly close.
weekly close. Yeah, we closed above them last week.
And all
So
of
we're
these were just wicks,
yeah,
like, so for people understanding, like, we went up, but we didn't close above those levels. Price action
right.
quickly came back down. So he's just kind of emphasizing that we closed above this
That
liquidity area right here.
right. So when you think about areas of liquidity, it's like a magnet, right? So when you're able to find them, it's gonna like magnetically go to that next one, which is right there above. I believe it's between 4230 and 4270 on the S&P 500 futures. Now we know here the SPX, which is what we trade, is $31 to $34 less than S&P 500 futures. So the futures, I was looking at the contracts, and for Monday, for tomorrow, we have a super high open interest for 4250. It's like maybe 3,000, and it's way more than any other contract. So that's something to think about. Also on Friday is open interest or expiration. So or options expiration. So
Yeah,
OPEX.
OPEX.
Yeah, OPEX on Friday. So that's something else to think about for this week. But just looking at that area of liquidity at the top between 4230 and 4270 is probably where we're going to go, and then snap right back down to October lows, which you see at the bottom with the blue.
Mm-hmm.
And, we'll probably bounce from there and then drop below October lows. And then on the right, I have a diagram that shows you kind of, why I'm saying liquidity. People call them inducements, ICT. We take information, we digest what the nutrients are that's going to help us with our trading, and then we, discard everything else. So that's showing you the ideal schematic on what's actually occurring right now.
Mm-hmm.
So
And this
if
is
we're
the kind of
looking
the
at
phase that we're at right now, right?
Yep. And if we're looking at why we're thinking, okay, possibly we're not in a bear market anymore, or we were actually in a bear market, the average loss in a bear market is around like 35%. So it's around 35%, and it lasts less than 1 year on average. So on average, a bear market lasts less than 1 year, but it has to be a 20% decline over a 6-month time period. Like, so over a 6-month time period, 20% decline, you're officially in the bear market. So from the all-time highs of January 2022 to the June 2022, that would have started the bear market, because in June 2022, we were dropping below 20%. And this is it was 6 months out from all-time highs. So that would make, October being, the possible bottom, So I want to have two scenarios. If October is the possible bottom, that means we're going to go to that area of liquidity. We're going to get there between 42.30 and 42.70, and we're going to exceed that level. We're going to go to 4,400. If that happens, then October was the bottom. If that doesn't happen, then exactly what we're talking about right here is going to play out. We're going to hit that level of liquidity, drop back down.
A lot of people are saying some similar things with Bitcoin as well. Like if Bitcoin gets above 31,500 and can stay above there and really hold above there, then they're saying that also, the bottom was in.
Yep. And we actually were discussing the possibility on that as well. But that decline from all-time highs to October lows was a 27.1% decline. So that falls into the line of the percentage for a bear market. So that's why we're looking at where we can possibly go and catch all of the moves in between there. We can grab some stocks and grab some things for our long-term accounts and make some money in the meantime. So that's what we're looking at right there.
Mm-hmm. And so this is kind of more of the bearish scenario, right? And so it kind of leads up with this low volume rally, right? And so if hedge funds are overweight cash and all of this stuff, and they're not really very short the market right now as well either, and this is simply a liquidity inducement, this rally up to that 42.50 area that you're speaking of, we could actually see volume increase a lot here. And if it increases and we start to pull back, then most likely what we're seeing is that liquidity inducement, and we're going to come back down and potentially retest some of the lows.
I'm sorry, bro. Or exactly what you said, if the volume increases, but it's by volume, because a lot of people have cash. If I was a financial advisor, I couldn't tell you why I'm, investing when, people think that the market's going to go down. You're watching CNBC and everybody's like bearish. Oh my gosh, it's going to crash in flames, wait. But I wouldn't be able to properly advise you and say, hey, I'm putting this in here because of this. So if we get a spike in volume and it's by volume, it totally invalidates that whole declining volume. But if we get a spike in volume and it's how it's supposed to be, which is the, sell volume, then okay, you know what, we get that certain, that pullback. Also, if you look at that schematic right there on the left-hand side, the two middle peaks, it makes a 3 drives to a high pattern. So if we don't get that buy volume, we have multiple things telling us that we're going to pull back. Not only this schematic, not only the liquidity, but also if that's a three drives to a high, usually it pulls back to the 0.618 retracement, and those two peaks actually have pulled back to the 0.618 retracement. Somewhere around there. The first one did, second one was somewhere, around there. So we know how the market is. It's not perfect, but that's another thing that leads us to believe we're going up. So if we get that buy volume that Zach is talking about, and people are like, oh, this is it, it's a wrap.
Yeah.
But for now, that's
and I think that the market is going to be bullish overall. Either way, right now, the way I see it is we either, have a slow grind up, or we get this flash crash and we kind of have one big last drop. And whenever we create the bottom from there, I think that, the market's going to aggressively rebound and recover from that. So, I'm kind of more bullish overall. But I'm pretty open to a bearish scenario like this scenario here that we have. And if you notice, he talks about drop to create the spring. And this is what he's going over here is this Wyckoff schematic right here. So if you want to go over this a little bit more, but essentially, you would get this spring / shakeout, and then you take off from there, guys. So, we have the scenario where if we come up to here and we're really able to close and stay above these levels and really start seeing some buy volume, then we could continue and staircase our way up. But even if we do, as I mentioned earlier, get this flash crash right here, it falls perfectly with the Wyckoff accumulation schematic. And, most likely we would see a very strong push to the upside afterwards if we come down and retest some of our previous lows or potentially even break those lows. So I'll let you just dive in a little bit deeper into it.
Right, you said that perfect, and literally that's something I was looking at starting off maybe a couple months ago, maybe almost 6, 7, 8 months ago, something like that, when everybody had that one trend line, and I was like, this is looking like it's setting up to be a Wyckoff. And then I was saying around, October, I was like, yo, this we could possibly go back to all-time highs. And then I was telling, Zach, and we were talking about it, and I was like, bro, I can't like rationalize it. You know how technicals are where you can't
This
really
is kind
tell,
of
but
that famous trend line that you're speaking
famous
of right
trend
there.
line. Yeah, and then it broke, and everybody was like, "Oh, this is it." And then it went back below the trend line. But the whole time, I'm like, "This is a Wyckoff accumulation schematic. We just don't know if it's number one or number two. So one of them is the one where it pulls back down, like we're talking about right here, creates the spring, and then it's like a slingshot. Once it creates that spring, it's go time. Or there's one that like slowly grinds up from, phase B, C, D, and then it slowly grinds up to create that bullish run. So what we're thinking, looking at the volume and looking at, multiple things, we're thinking it does go to around 4,200. Above that, we're in phase B. Then we drop down, take out the October lows. We create that spring, and
Mhm.
around like 3,400, 3,500, somewhere around there, whatever's below the October lows, that's when we're looking to, go long, because everybody is going to get, they're going to get faked out. They're going to be like, oh man, like we're going to like crash and burn. And that's not what's going to happen,
And each
because
time, even each time that we created a new low, the
Mhm,
market rebounded very heavily, right? Like over here, we created a new low, we had a strong
mhm,
push up, created a new low, strong push up, new low over here, very strong push up. And this is when we had that most bullish bear market rally in
mhm.
history. And a lot of people were saying that, hey, the bear market's over. This rally was too strong. We haven't seen a rally like this in a bear market. But we've actually really been living through some historic times, and so a lot of things that have never happened before happened within the last year, as well as the past 3 years, really, since COVID. So
Mm.
that's just something to keep in mind is, each time we do end up creating these new lows, it's been a really good buying opportunity. And we've seen some very aggressive recoveries afterwards. And if, this schematic is going to play out with the Wyckoffs here, then, we could see that. Now, this scenario doesn't have to play out. As we
Mhm.
mentioned, we could come up here and, if we start to really see that buy volume increase, because we really haven't had any buy volume on this whole rally here. If we do see that volume to increase, then that's when we really could, consolidate around this area, maybe retest here, and then break out and try to head up to the 43, 4,400 area on SPX. So
43.25 is the number, though. 43.25. If we actually, as Zach said, if we do get that bullish volume above 43.25 closing on the daily, it is going to all-time high. So that's the number we're looking at. We're open to, both sides, but anything below 43.25 will still create that new peak on the Wyckoff scenario for us to, pull back. So around above like 4,200, I'd start looking for a bearish divergence on like the 4 hour, that could work into the daily. I start looking for that bearish divergence so we can try to catch that move back. And if you're in, long calls, or if you're bullish, you can actually take profit. So 43.25 on SPX, which would probably be 40 431.50 or something like that on SPY.
mhm.
Um, so look for that. If we get above those levels and close, don't say nobody told you. We were, me and Zach are here saying, both sides of the spectrum. So if
Yeah.
we don't do that, you can ride it all the way down. You can ride it all the way down and make money on the way
And
down.
so just to add fundamentals to some of this stuff, okay, because a lot of this is technical analysis, the fundamentals is really the stuff that we went over in the beginning, right? So for us to really get that flash crash, and let's say we get that flash crash you know, a lot of the crashes have been driven by the Fed, right? If we take a look right here, this was Jerome Powell's Jackson Hole speech when we had that insane bear market rally. And then Jerome Powell came out, gave his Jackson Hole speech, and the market tanked and created new lows afterwards. And those lows were the bottom over there in October so far. So, you know, if where are they? If the crude oil futures continue to go up, and those are going to be a leading indicator again for core CPI, right? Then we're going to see core CPI start to tick up over the next coming months in the summer, right? It's not going to happen immediately. CPI is lagging, but core is what the Fed focuses on, right? And so what will happen is summertime will come around, and if crude oil futures are still rising, most likely core CPI is going to end up rising after that and be lagging. And what's happening this summer? Well, the debt ceiling, right? And so if they raise the debt ceiling, so now what we have is this scenario where the market is freaking out because inflation has actually gone back up, core CPI has actually gone back up. And so now they're pricing in higher rates for longer again, right? And so the market drops, right? And so that's a scenario where, from the fundamental reason, that's where we could get this move to the downside. But why would the market rally and recover after this from the Springer shakeout? Well, because if the Fed is adding to their balance sheet, guys, then the stock market goes up, right? We have the Fed balance sheet here going up. And what do we see? We see the stock market going up. If we zoom in and even look at the most recent data when we had the banking crisis, guys, how are banks literally falling apart and collapsing and the stock market is rallying afterwards, not panicking? Well, it's as simple as this. The Fed balance sheet went up and the stock market goes up. So, you know, that's the scenario where if inflation does come in hotter, a lot of people are going to price in higher rates for longer, but that will most likely be reflected sometime in the summer. And the debt ceiling, like I mentioned, you know, is in my opinion, I think that it's going to be raised. Okay, they keep raising the debt ceiling all the time. It's a big, you know, debate between Republicans and Democrats. I'm not really too political about this stuff. I just kind of look at what history is, right? And they keep raising it. So, you know, what they can do is they can fight inflation and still keep their foot on the gas with the Fed fund rate. But, you know, if the economy is collapsing and we're seeing more banks having problems, or just other things like that, you know, I don't see a reason where they wouldn't be, you know, necessarily keeping rates tight, but also adding to the Fed balance sheet and really putting an end to quantitative tightening, because quantitative tightening is the only reason that we've been seeing the Fed balance sheet go down, is because they're allowing, you know, they're just rolling off treasuries. Now, if they start purchasing treasuries again, which is what happened over here when they started to, when they, you know, purchased the toxic treasuries from the banks to bail them out, essentially, you know, we saw the stock market go up. So, you know, if you want to look at things from a fundamental point of view and combine that with the technicals, that's really what could happen here, to where we could, you know, this is a scenario that would make sense, right? If over the next coming months, crude oil futures are still going higher and it's still a leading indicator for core CPI, and then we start getting in some hot CPI, you know, the market may crash, right? Because really we've been rallying a lot off of inflation coming down and getting softer inflation readings, right? So, you know, that will change the whole narrative for a lot of the rally that we've seen. We get a flash crash, we put in a new low, or we come back down and retest the lows. And then at this point, the Fed is like, hey, actually, we're about to raise the debt ceiling. We're about to start buying some treasuries back. And that can be some of the fundamental reason that we go from the spring or shakeout all the way up to the range breakout up here, and really head into the next bull market. So I kind of
Can I
just
play
wanted to
devil's advocate?
retie everything in together that we went over, so you guys have a good idea of what it is we're actually trying to portray and convey here.
Can I play devil's advocate real quick?
Yeah.
And just to add to that, so when we drop down into that spring, well, not when, if we drop down into that spring, what's going to happen is a lot of people are going to see us drop below that 200 SMA on the, you know, the daily or the weekly, and they're going to be like, wait, hold on, like, we might really be like going down. We might really be in for a huge crash, and it's going to be pandemonium, panic, or whatever. So, do you think that one, that is plausible, and two, do you think that would be the perfect time for the Fed to, you know, announce what they're going to announce, or, you know, for the debt ceiling to be raised? Because what they had essentially wanted is happening. People losing their jobs, the market going down, prices coming down, like, disinflation is happening right now, as you can see with, certain data. But as you pointed out, energy is probably going to, spike that again, still sticky. So what do you think about, like, on the weekly, if they, drop below that 200 SMA?
The 200 SMA is going to be interesting because there was a lot of buyers. So a lot of funds, a lot of institutions, a lot of retail traders will simply go long something or go short something because of the 200 SMA. So that is a pretty good point to make there. And, that would be kind of that panic scenario, right? So we have the 200 SMA somewhere around 3,800 over the next coming weeks. It'll definitely be up to that level as we're higher than there, and it'll gradually tick up. And if we break below that 3,800, it's going to cause a lot of panic and cause a lot of capitulation, in my opinion, And then if that happens around sometime in the summer over the next few months, then it would, kind of make sense for the Fed to be like, okay, hey, things are falling apart here. The market's making new lows. What are we going to do? Well, let's look at inflation. Is inflation down? Can we start cutting rates? And if inflation's higher and sticky and really a lot of the fuel for the move to the downside, then they're not really going to be able to, immediately start cutting rates, right? And that's just my opinion. That's what I think. But if they raise the debt ceiling, then what they can do is say, hey, we're going to continue to fight inflation, but we're going to actually start stimulating the economy right now. So that's kind of where I see things going is I see a scenario where we do very similar to what Europe is doing, and they're raising rates, but they're also stimulating the economy and adding to their balance sheet. The central bank is and stuff like that. So
I
that's kind
like
of what I
that. I
think.
got one last question. And I know we've talked about this, but I want it to just be documented and recorded. But do you think, covering as many, crypto happenings and research that you cover, do you think that um, Signature Bank and Silicon Valley Bank, do you think that they only wanted those two banks to go down, but the public and retail investors, and they kind of caused bank runs on other banks um by mistake? Do you think that it was just a hit on Silicon Valley Bank and Signature Bank because they were, the top funders or, startup investors in crypto, and that was something like a castle that they had to take down? And that's why the banks that you see on Friday and tomorrow, Charles Schwab, and I don't know if you remember, but Bank of America made like $60 billion in one day off of depositories because people had bank runs and they wanted to go into bigger banks. So when we're thinking, oh, the banks are gonna go like, they're gonna go so low this earnings season, like that's probably why we're getting surprised on Friday and possibly, tomorrow. So what do you think? Like, was that a plausible threat, or is
Yeah.
there
So
something underlying there?
when we speak about banks, I think it's very important to make a difference between the too big to fail banks, right? Like the top five banks in the US. They're pretty much nothing like these smaller banks, the mid-sized banks, and the regional banks. A lot of these big banks, they don't even do the type of loans that these smaller banks are going to be doing. And so what I think it was a little bit of a target, as you were saying, because there were a lot of big banks and analysts for big banks putting out hit pieces on some of these smaller on these smaller banks. Now, I mean, they were justified because they were underwater on a lot of their treasury positions, and they really just had almost malpractice really when it comes to just the way that they were buying treasuries and stuff, and not really having any type of inflation hedge. But I think that crypto in particular is pretty much ran through Twitter. Okay. And Twitter is kind of like the go-to space for crypto, right? That's where most people get their crypto information from. That's where crypto news spreads first. And that's what we saw with Silicon Valley Bank is we saw that, you had the top depositors there, a lot of the top CEOs of these venture capitalist firm telling all their friends and tweeting all of their other rich friends saying, hey, pull your money out of Silicon Valley Bank with me now because it's, because Barclays or because Goldman Sachs or Bank of America just put out this hit piece on them and they're doomed. So, if Twitter wasn't around, we probably wouldn't have seen that bank run, in my opinion. And, just the digitalization of money made it so easy for everyone to just immediately start, withdrawing their funds out of the bank and transferring it to another bank or a larger bank. So that's kind of what I think about it is like, they were targeted by a couple companies, but they were also right. I mean, the short sellers were dead on. They nailed it with things like Silicon Valley Bank, and they did it. They were underwater on their treasury positions, but the bank runs wouldn't have happened if it wasn't for Twitter. And people really, and you have these big venture capitalists really saying, hey, I'm taking my money out, you guys need to take your money out too. And it was really big amounts at a single time. Pretty much like all of the funds in Silicon Valley Bank weren't FDI insured, meaning that they were above $250,000. So that's kind of just my take on it. And I really think that with the bank collapses were just starting. And but there's a big difference between the big banks in America and every other bank. So these big banks, they're benefiting from all of this, right? And they're getting a lot more of those deposits. Commercial real estate is in a really ugly space right now, and it doesn't look too good for commercial real estate. And commercial real estate loans are pretty much done through these regional banks and through these smaller banks, because these are generally more risky type of loans, or maybe they're more aggressive. And the JP Morgan, Chase Bank isn't really going to offer you that loan. They're just not even going to reply to you when you apply for a loan for that, versus these other banks. They're the ones you're actually going to get these. And that's why you see all of these big venture capitalists at these smaller regional banks, is because they're getting a lot of benefits from these smaller banks and the type of loans that they're getting, or just the lending procedures, due to the large amount of money they have. So it's like they took all the good with the good, and as soon as things went bad, they kind of just went straight to Twitter and collapsed the bank, caused the bank run.
Yeah, I agree with that. And, I'm not going to like shy away from, the other things that you said as far as them, mismanaging certain things, because like, let's be honest, like at Silicon Valley Bank, the CFO used to work with Lehman Brothers. Like, come on.
Yeah.
Come on. I don't know about you, but like, come on. Come on. Like,
Yeah,
how
and
could I not expect
didn't he
this to happen?
sell a huge majority of his shares right before the bank collapse?
Dude, come on. Like on top of insider, come on.
Yeah, so
Like
he's like, man, he's like, we're down huge on these treasury positions, man. If we had
we're
to
talking
liquidate these right now, we'd take a really big loss. So let me just sell my shares.
if we're talking like top five rappers, like he's two of the positions because
It's it
he was a part of two of the biggest, like
collapses.
the hugest collapses. Like, come on. Like
And so
CFO, not like a regular position, like CFO.
and these venture capitalists, where did they get the info from that they should pull their money out the bank? I mean, those
Oh,
guys, they're
that's
all complaining, saying that oh, well, how am I supposed to, I'm not supposed to just go through the bank's financials. I'm not a accounting expert, a financialist expert. I'm a tech innovation expert. So then that's what I focus on. So it's like, okay, well then how did you know that it's time for you to pull your money out the bank?
that's like me robbing McDonald's, getting caught. Everybody knows I robbed McDonald's. I don't go to jail because nobody went to jail for Lehman Brothers. Let's pay a fine, cool. Like, it's gonna go away. You're gonna get hired again, and then like going to Burger King and getting hired, but they knew I robbed McDonald's. It's like you knew he worked for Lehman Brothers. You knew what happened there. Like, we're not. Well, anyway, I don't
They're
want
like,
to.
hey, that was just a
I
bad
don't want to go too
situation,
deep into
right?
that.
You're not going to do
Twice
that
though.
again, right?
Twice.
We'll hire you over here, but we know you're a good guy. You're not going to do that again, right?
And you did the same thing. Let's not put all the blame on him, but bro, like yeah, come on. So I'm not gonna just put it in conspiracy. Like, it's a fact. It's a fact. You're a CFO. You work for Lehman Brothers. That right there. Anyway, we're past that. So
Yeah. So anyways, I think that was a good video today. We just kind of wanted to quickly go over, what are some of the possible reasons why the market's been rallying, right? And so, we explained to you guys, we showed you guys the charts with, the Fed balance sheet. And if the Fed balance sheet is going up, the stock market historically is going up. Right. We also took a look at some of the financial conditions. We gave you guys some different scenarios here that the market could see, and trying to just give some foresight, before things happen, and combine some technical analysis with also some fundamental analysis theories on where things could go in the economy, with Jerome Powell, with Janet Yellen, the debt ceiling, crude oil futures, core CPI, and just combining a lot of this data together to help navigate. Okay, nobody can know for certain where things are going to go, but when you start to look at a lot of these things in hindsight, the more and more it starts to seem that we're kind of living in a simulation where this stuff is going to happen automatically, and really you just find out the catalyst before. So one thing we like to say is price action always precedes the news. And so the price action will paint a picture, and you just don't know what the news is going to be, right? Sometimes it's a bank collapsing. Sometimes it's Jerome Powell giving a hawkish speech at the Jackson Hole, right? And sometimes it's due to earnings. So as long as you kind of keep an open mindset to some of the different scenarios, and you let the charts speak to you, and you don't really fight against what they're saying. You can't really, as I mentioned, predict the future. Nobody has a crystal ball, and a lot of times the price action will lead into things before these things happen. We were looking at the treasury yields, right? And we were looking at the 2-year treasury yield, and it had a head and shoulders. It had a huge bearish divergence on the weekly time frame, and it was setting up for a very big bearish drop. And what happened? The banks collapsed, and the treasury yields dropped. They tanked, and we saw the move coming. Now, did we know that banks were about to collapse and that treasury yields were going to puke because of that? No. But we saw that price action was telling us some type of big catalyst is about to come, and these treasury yields are about to fall. And sure enough, they did. So just kind of want to end things there. Appreciate you guys watching. Smash that like button, subscribe to the channel, and we're out.